Hi, everyone. This is Jack Allwild with another Money episode. Today, we have very special guest, Paul Mattos. He's a North Carolina and South Carolina mortgage broker. Paul, welcome to the show.
Thank you for having me.
I wanted to have you on to give the listeners a little bit more ammunition on what they should expect when they're going to purchase a home, what types of metrics they should be focused on. What are you looking at when
Mhm.
you are taking them through underwriting? Talk to me like I'm a kindergartner.
All right, I'll do that. So basically, when you're talking with a mortgage broker or mortgage lender, they're looking at your credit, they're looking at your income, and they're looking at your savings. Those are really the three pillars of what matter when you're applying for a mortgage. As a mortgage broker with access to a lot of different programs, I theoretically can find you a product if we have two of those pillars. So
Okay.
we can kind of break those down a little bit to, you know, what savings you should have, what credit you should have, and job history, income you should have.
Let's do it. Let's go. Let's go
Mhm.
savings first.
Savings. So again, depending on what your credit is and depending on your job history, there's different programs, or if you're like a first-time home buyer. So down payment on a new home is anywhere from zero up. First-time home buyer, if you're doing a conventional, meaning that your credit score is at least it's like 600, 620 in that range, or more, then 3% first time. Other than that, it's 5%. And then FHA, if your credit score is above a 5, below a 6, or below 580, then you're looking at 10% down. Above a 580, you're looking at 3.5% down. And then, of course, there's other programs out there like, USDA, VA, and all sorts of things. So really, it's for someone who's just getting into it, I would say try to save up 3% of the home price you're looking to get, and then an additional, say, $5,000, $6,000 for closing costs.
Okay.
Mhm,
So they're looking to get a
mhm.
$100,000 home. They should be coming to you already having at least 3% saved up, plus
Approximately, yes.
another, plus another. And what are closing costs going for right now?
So closing costs are about, anywhere between five and $7,000 right now. It all depends on what time of the month you close, as
Okay.
well as things like, interest rates. Our insurance. Like insurance is going up right now. So we're starting to see a little bit of an increase in closing costs because part of your closing cost is priming your escrow as well as paying that first year of your insurance. So attorney fees are sitting there, 600 bucks. You've got inspections, you've got appraisals, and then of course you have your loan origination.
Interesting. Okay.
Mhm.
So part of the closing cost is prepaying the insurance essentially.
Yes.
Okay. Interesting.
Yeah. Insurance and
Um,
taxes.
okay. So let's go to income.
Mhm.
We hear this debt to income metric thrown around. What is that?
All right, so debt to income is interesting because you have two ratios. You've got what we call your low end ratio, and we have your high end ratio. Your low end ratio is your total monthly debt that you are paying on everything you have debt on. That could be your student loans, that's your car, that's your credit cards, that's everything. Your high end ratio is all of that plus your new mortgage.
Okay.
Um,
And
it,
and
Go ahead.
and just to clarify, when you say total monthly debt, it's all the principal and interest payments. It's not just the interest portion.
Well, yes. So we're talking
Mhm.
about, yeah, exactly.
Yeah.
So
Okay.
it's the full debt that you're paying every month on those items.
Okay.
And to be clear, like say you own another property, like you own a rental property, we're also going to count the HOA of that rental property in that. So even though that's not the mortgage itself, you still are obligated to pay that. So it gets counted towards your debt payment.
Interesting.
Yep.
So it's really any, I guess, pre-forecasted expense they'll include.
Pretty much. Yes.
Okay. Okay.
Child support's one of them.
Hmm.
Yeah. It gets put on there.
Okay.
But so depending on the type of loan that you're getting, USDA, you're looking at like 41% high end allowed. conventionals 49%, FHAs 57.99 on the high end. The low end matters. And if you look at traditional knowledge of what's in all the textbooks, they're going to say keep your low end at like 28, your high end at like 36. That's what they say. That's the rule, but there's a lot of exceptions. So in reality, you're seeing conventional people at 48% high end DTI, and then you've got your low end maybe sitting at like 38, depending on where you're at.
Okay.
Mhm.
And as far as the income component in the debt to income, is that
Mhm.
gross income or net?
That'd be gross.
It's gross. Okay.
Yes. So that's your total income. Now,
Okay.
income is interesting because there is so much to it. Um, as a mortgage broker, I have access to all kinds of programs, you know, bank statement. I mean, I can do just crazy things that are kind of interesting. But traditionally speaking, a typical lender is going to ask you for 2 years of work history. That gets confusing to a lot of people because they don't mean 2 years at the same job. I
Hmm.
mean 2 years of work history. And then what they're looking for is consistency, and they're looking for the likelihood that your job or your income is going to continue forward. So, like, for example, say you're an hourly worker and you're making 40 hours a week and you have 2 years of work in maybe a couple different companies, but you're consistently the whole time doing 40 hours a week. That's good. That's great. Or say you just started a new job and we may try to get an exception of some sort without the proper work history if your current job is willing to guarantee that they'll give you 40 hours a week.
Hmm.
Or we just love salary because that's a guaranteed income anyways. Um,
Interesting.
but then like if you're doing someone who's self-employed, and self-employed people, they're writing things off. They're not paying a ton on their taxes, usually, sometimes. But in that case, you might look at something like a bank statement, in which case you're going to take your average monthly deposit over the course of 12 months or 24 months, and then you're going to multiply that by a multiplier, which is usually 50% expense ratio to get your income. And then you take that income and you use that with those ratios.
Okay.
So really it's 1/4,
Hmm.
unless you get an
Interesting.
accountant to write a letter to get a lower expense ratio.
Hmm. So if someone's really deducting like everything,
They wouldn't qualify for conventional because they don't have
yeah,
income.
yeah,
So your option in that case is do a non-conventional loan, like a bank statement or a P&L loan, which is essentially the same thing, but a letter from the accountant.
okay,
There's a lot of options. I mean, when you're talking about this, like, there's so many aspects to income. And that's why I said, like, you have the three pillars, savings, income, and then your credit score. All these different programs have different requirements. So, like, you're talking about down payment assistance, someone who doesn't have a lot of cash, maybe like $2,000 for earnest money. You can do that. You've got to have a job. You've got to have income. I mean, you've got to have income. You've got to have okay credit, usually about 640. But those are the two pillars you have. We can make up for the third one because you're missing it.
hmm.
Or like you
Are,
don't have a job, but you have credit and you have some savings, put a little bit more down, you do something like a bank statement.
hmm.
And that's kind of how that works.
Are most of those
Mhm.
pay assistance, are those all government like agencies?
There are some really good government agencies that do down payment assistance. There's some really good ones. But I have found that they typically have a drawback. And that drawback is usually in the form of it being a bond. So I won't say names, like the biggest one that everyone talks about is about $15,000 and it's on a 15-year bond. And it's like the first couple of years you have, if you sell your house or refinance, you gotta pay it all back. And then after 15 years, it forgives and it kind of has that period in between. There's other programs that I've kind of become a little more accustomed to that are grant programs. And those programs typically have different requirements on the DTI. They'll have maybe a little rider here or there, but they give you a grant. So you're forgiven the day after closing. And like, for example, I have one right now that is considered a 1% down program. It's for a first-time home buyer. So you're talking about a conventional 3% down. You've got to have a 640 credit score, and it's 2% or $4,000, whatever is left or less towards your down payment. Now, that's not your closing cost. We can ask for the closing cost or a good portion of it from the seller. And that's how some people are getting into homes with very little money down and still able to sell their house or refinance in 6 months if they want to, without having to pay all that money back.
Mm-hmm.
But there's a lot of options. At the end of the day, there are so many down payment assistance programs out there for people that they can take advantage of. So yeah, if, like I said, if you have two of the three pillars, or you have one pillar and you're able to work a little bit on the second pillar to get there, there's a path. It's just a matter of taking the chance, talking with someone like me, and finding that path.
Now back to the bond versus grant. So a grant, just for clarification, like the grant doesn't need to be paid back, but the bond, it is like a separate loan, essentially, right?
Kind of. Like typically they're no interest.
Okay.
Like they're government grants. The idea is to help out someone who needs the help. And you would have to pay it back, or at least a portion of it, if you did something with that loan, sold the house, or within the next 15 years is a typical one. So that's a bond. But they're good programs. I mean, in reality, they do have some good uses, and it really just depends on what your needs are to whether or not you want to go that route. Because especially in the Charlotte market, homes are appreciating so fast that I've seen people who got those bonds, a little while ago, sell their house, and yeah, they had to pay it back, but they've gained so much appreciation that it doesn't really matter. So it just depends on make the numbers work for you, and end of the day, you're ready to buy a house when you're ready. So we'll make it work.
Okay, so let's transition to the third pillar, credit.
Credit.
What can you tell us about one's credit rating, or what should we be shooting for?
As high as possible. That is the answer. So credit is interesting because I don't want to get my beef with the public education system in this country, but we don't teach credit. Why don't we teach credit? I talk to a lot of people who just don't know anything about it, and I feel bad for them. So the thing about credit, it's, as Dave Ramsey would say, which I know you love, it's I love debt score. To have good credit, you have to keep your debt utilization low, but you've got to use it. You've got to pay everything on time. And they're just I feel like they don't want you to know that because they want you to use your credit score, your credit. They're giving you $1,000 card, they want you to use the whole thing. I'm telling you to maintain a high credit score, keep that utilization low. So if you have $1,000 credit limit, you should be trying to keep it below $100. So you go buy gas with it, you buy groceries, you pay it off. But people don't do that. So when I'm talking about credit, your goal, like say you're a first-time home buyer, really you want to have at least a 640, because that gets you into like the Freddie, Fannie, Home Ready, Home Possible type programs, and some of those down payment assistance grant programs. But other than that, you want to be as high as possible.
When you're doing the underwriting, are there like buckets? Like, are there any other like key numbers? Like, if you can get over that, then your interest rate will drop significantly. Like, what are those significant hurdle numbers?
So we're talking about trying to get you the best deal possible using your credit. So yes, typically about an 780 is going to get you into like that top bracket. The lower brackets are spread out a little bit. Obviously you got the 600, the big hit, the 620, and like the 660 are going to be other brackets. And that's when I'll start seeing changing in the pricing. Another indicator that's going to change your pricing is your down payment. So first time home buyer side, that's a whole different thing, because first time home buyers get great pricing with a 640 typically. But when you're a move up buyer or someone who's doing a investment loan or something along those lines, there is a huge price difference between doing 10% down, 20% down, and then another one at 25% down. And those are things that kind of impact how much you're going to get on your interest rate.
Mhm. Can you give us a sense like how much the rates would drop at some of those percent of a down payment?
Talking very, very averaging here, but
Mhm.
maybe an eighth
Okay.
per step in that
Okay.
range.
Okay.
It's enough that it's worth looking at if that's the way you want to go. Plus,
Okay.
keep in mind if you're doing a conventional loan, you've got your mortgage insurance. You don't have that at 20% down.
Mhm. And then also on the terms of the loan in terms of duration, going from like a
Mhm,
30 to a 15 or somewhere in between or even less, how do the
mhm.
rates fluctuate if we go
Typically,
lower?
15 is typically a little better. Keep
Okay.
in mind, from the perspective of the lender, it's less risk. So they're giving you $500,000 to buy a house, and you're telling them, I'll pay you back in 15 years. They're
Yep.
willing to take a little bit less than an interest rate on that because I'm going to get my money back in 15 years. I don't have to wait 30. So, yes, it does impact it. Um,
Any sense of how much right now?
Not many people are doing 15-year loans right now.
Yeah, I figured. Okay.
That's the truth. Just because, I mean, you get a lower interest rate, but your payment's still higher.
It's true.
And yeah.
Yeah. Shameless plug. I do have a an
Mhm,
affiliate called Smart Credit. You can check it out in the link below. It's I found it very helpful. I mean, you mentioned the utilization rate.
mhm.
Just little tweaks like asking your
Yep.
credit card company to increase your limit and then your on paper your utilization rate looks lower. That
There's a
helped me a
l-
lot. There's like little things it recommends you do.
mhm,
So I'll include that link in the description, but that's cool.
yeah.
Okay. So what else do we know, Paul?
Get pre-approved. You know, the fact of the matter is, you don't know what you don't know. So, say you're, here's the thing about real estate. Homes are, for lack of a better word, sexy. You have that nice kitchen, you have that nice yard. You're sitting there on Zillow or Trulia or, homes.com, and you're looking at houses late at night, and they're like, you want those. So people tend to have the idea that you need to start with a real estate agent, go look at some houses and find it. And a real estate agent is important to the transaction. You really need to have one if you're buying. But I would argue that you need to start with the lender because, like we talked about with those three pillars, you need to find out where you are, what your situation is, how much home you can afford, and what payment you're comfortable with. Because I've seen it happen. I feel so bad for some people because, I always upfront underwrite all my people. I scrub their files, make sure that they're clean. But I've seen people go under contract on a house. For one, you're putting your earnest money down. You're putting your due diligence down. Due diligence, you do not get back. That money's gone if you do not close on that house. Your earnest money, there's a chance you'll get it back, but there's no guarantee. So you're gambling that you're going to be able to purchase this home. So, like I said, you don't know what you don't know. Talk with the lender, let them collect all your docs they ask for, give them everything they need. Then you can open Zillow and
Mhm.
start looking.
Yeah, I remember back when I was looking for a house, my first one, I don't even think the agents would show me properties if I didn't have like a pre-approval letter.
The good ones won't.
Yeah.
Yeah, I mean, the truth is, most agents that I work with, some of them will meet you the first time just to kind of get a feel for you and
Hmm.
introduce themselves and, you know, have you guys figure out what your goals are. But a lot of them won't even do that. They want to make sure that they're not wasting their gas, they're not wasting their time, and they want to make sure that you're serious.
Yeah.
And the best way to show you're serious is have that letter in your hand. I'm good
Hmm.
for $600,000. I've been checked. Here it is.
Hmm.
But that's
Cool.
the biggest thing, just because There's so many things that could go wrong. And, you know, other thing I would say is try. I mean, as we talked about with down payment assistance, with all these different loan programs, you may think it's hopeless, or you may have talked to one lender who told you that it's not going to happen for you. Well, ask what they checked. You know, how creative were they? And give it a shot, because you don't know what's going to happen. And I have a customer right now that is looking for houses that is pre-qualified, pre-approved. And 6 months ago, they weren't. Put them in touch with a credit repair company, fix their stuff up. They're good to go because they talked with me. They got a game plan, and now they're out looking. Soon they'll be homeowners.
Very cool. Does the financing change at all for people that have homes right now and are looking to either refi or take out like a HELOC?
Well, there's a lot of options and there's a lot to cover there. So refinancing and HELOCs, it just depends on, are you talking about your primary or secondary investments?
Yeah, primary. Let's stick with primary.
Let's say primary, because there's all different. There's different programs for each and every one of those. And the thing about mortgages that are kind of interesting, I'm going through this right now with a couple customers as well. You massage the rates. So all because the rate is at a certain point, and rates have been coming down recently. And I'm actually just because I'm doing this with some clients right now. You get them a lower rate over time by refinancing them into a lower rate. You know, right now I have access to a couple of really good streamlined refinances that don't require appraisals. Lots of those are easier, but I just say, you know, if you have a home you're in right now, maybe you weren't too happy with the payment, keep an eye on the rate, keep talking with your mortgage broker, and then refinance it into a lower rate. Rates go up, okay, you're at a lower rate now, you're good. Rates go down, you refinance again. It's not that difficult. As for things like HELOCs, those are great programs, basically using your house as a credit card, and they are better interest rates than most credit cards. So they're good programs. If you have the equity, I'd recommend taking advantage of them. We got some really good HELOCs I'm working with right now.
As far as the underwriting, like if someone's in a house and they're looking to refi, is the underwriting essentially the same? Or how
Depends on the refi program.
Okay.
So streamlined refinances typically don't require that as much as if you're just jumping into it. But if it's a, you know, like not a streamlined, just a regular refinance, then yes, it's usually about the same.
Okay.
Yeah.
Okay. Well, Paul, I have enjoyed this discussion, and I think you've given the listeners a lot to think about. Where can they go to get in touch with you or learn more about your services?
CarolinaHomeFinancing.com.
Cool.
I'm a mortgage broker, shop out to multiple lenders. I'm licensed in North and South Carolina. So anybody looking in North or South Carolina, if you're not in North or South Carolina, find a mortgage broker. And that's it. So CarolinaHomeFinancing.com, take you right to me.
Awesome. Thanks so much.
Thank you.